Hi, I'm Don Boroian, Chairman of Francorp. I'd like to talk to you today about a couple of things that are very important to us as we meet this challenging economy right now that is raising havoc with a lot of the financial markets. And it definitely will have an effect on franchising as well. However, contrary to what you might think, it's going to have a positive effect. For example, the biggest growth of franchising has occurred during these downturns in the economy. And we're going to look at it in two ways. First of all, why it makes sense for you as a franchisor to expand during this particular time. And secondly, why you need to change your message to prospective franchise buyers to meet the economic perceptions that people have about whether or not it's a good time for them to buy a franchise. First of all, as a franchisor, there's a lot of uncertainty in the market. Many companies right now, as they hear all of the economic woes and credit issues and so on, are pulling in their horns. They're not expanding. Particularly companies who are looking to expand with borrowed money or looking for investors to open operating units. First of all, we all know that investors don't invest in companies to open 10 stores. The return on investment to venture capitalists is not sufficient to justify that kind of investment. They don't want to be in a situation where their money is tied up for 3 or 4 years before they begin to turn a profit by the time you open operating units and put managers in them, and the amount of return on invested capital at the unit level, which generally is about 15%, has to be split between the investor and you. It's just not a sufficient amount of money. In addition, during times like this, investors are investing their money in distressed merchandise. Depleted value of stocks are a bargain for investors. And the money from the venture capital people is not going into startups or development of relatively new companies. However, there's a silver lining to all of this, and that is that as a franchisor, your ability to move out into the marketplace is going to be enhanced by the availability of opportunities for you. For example, if you're in retailing or in restaurants or any business that needs to go into a shopping center or into inline stores, there are going to be more vacancies in areas now that you might not be able to get into when times are good and business is booming. Those stores are already filled. Right now, some of those stores will become available. Even though you may not have the capital to go into those stores personally, this is where franchisees come in. And while we hear all the talk about credit and difficulty in getting credit, remember we're dealing with a different buyer. For example, if you have a retail store or if you have a restaurant, you need hundreds of customers to come into your store every day, every week. But in franchising, we don't have to sell hundreds of franchises every week or every day or every month. We only need to sell 1 or 2, certainly in a time like this if you're a new emerging franchisor. And the people that you're going to be selling franchises to are more abundant now in quality. These are people that are being laid off, downsized, re-engineered in companies that are laying off people or going out of business. And these are people that have been working in these companies for a number of years. They have good credit. They have a high credit score. They have equity in their homes that can get refinanced at their local bank because they have longevity in the community and they are very good credit risks. In addition, these are people that have excellent job skills. Many of them are middle managers. These are people that always really would like to have owned their own business, were afraid to leave the job and risk their fortunes on starting a business. But now that that decision has been made for them, they're on the market. And many of these people have gone to job interviews only to find that companies in their same industry that have just laid them off are also laying off people. That's when we get their interest in buying a franchise. So that from your standpoint as a franchisor, there are going to be a lot of opportunities because your competitors that are not franchising are not going to be occupying more stores, borrowing money, opening more branches, opening more markets for their businesses. A good case in point right now is Starbucks. They're closing 700 of their stores. Now, for Starbucks to put a manager in an outlet and to make the entire investment in the store and to be able to make a profit over and above the manager's salary is quite different than for a franchisee who is to buy a franchise and go into a business and work 60 hours a week. In many cases, just making their salary without even a profit over and above that meets their needs. They just want to own their own business, be their own boss, be the captain of their own ship, master of their own destiny. And so many of these kinds of situations where companies that have corporate-owned locations, those locations are going to be available in retailing, in the food service industry, in anything that occupies a store where someone has already done the leasehold improvements. In the restaurant business, they have the walk-in coolers and freezers and 3-compartment sinks and grills and so on. And many of the landlords are bending over backwards, giving free rents to get tenants in there to occupy these spaces. And in the service business as well, many of your competitors, those of you who are in service businesses, these companies are going to be cutting back on their expansion because it takes capital. And not only just the startup capital, but the burn rate. When we sell a franchise, a franchisee doesn't expect to make money for the first 2 years. If they just barely take out a salary initially to get the business going, that's pretty much expected. They don't expect to walk in on day one and be turning a salary and a profit. But companies today can't afford to do that if they're borrowing a lot of money at their banks because, first of all, the bank financing isn't available to that extent. And certainly, as the credit markets and standards tighten, it makes it more difficult for companies to expand with company-owned units, where typically it takes 2 years to get to a break-even point. And so those of us who are franchising our businesses have a great opportunity here because our competition is pulling in their horns. You have 3 choices right now in this current challenging market. Number 1, pull in your horns, hunker down, climb in a foxhole, wait until the storm blows over. If you do that, you're going to miss a lot of opportunities. But companies that need capital in order to expand their own company-owned units are going to have to do that because they don't have the available capital. A second strategy is to do what you're doing right now. Just keep on going and keep on your current expansion strategy. But again, companies that are doing this with their own company units are inhibited by the inability to get capital and by their inability to move out into other markets and support these kinds of expansions. A third option, and this is an option great for franchisors, because this is an opportunity to look around and capture markets that are being abandoned or not expanded into by your competitors. And by franchising, you're allowing yourself to go into these markets with the capital resources and the human resources of others. So from your standpoint as a franchisor, this is the time to move out.